Interesting. So I'll go ahead and say that again. Today we're going to be covering how to pick an options contract for swing trading. All right. So first and foremost, we have to give a disclaimer. I am not a financial advisor, and this is in no way financial or trading advice. I am simply sharing options trading strategies that I use and have been successful with in the stock market. This presentation is for educational and entertainment purposes only. There are significant financial risks involved with trading, and I am not responsible for your losses in the market should you decide to utilize the information and or strategies discussed within this presentation. By choosing to proceed, you are acknowledging your understanding of this disclaimer. All right, so we're good. Now, 3 things you should always ask yourself when it comes to trading options. Number 1 being, what is the volatility of the stock? 2, what is your account size, budget, and risk tolerance? Now, the reason why is because it is so important to know the volatility of the stock. And I know the word volatility sounds scary, but it's not all that bad. A highly volatile stock is inherently riskier, yes, but that risk actually goes both ways. When investing in a volatile stock, the chance for success is increased as much as the risk of failure. And if the stock's price fluctuates wildly, so if you see it hitting new highs and new lows, or if it moves erratically, that would be considered a highly volatile stock. And I want you to always remember this, you guys. A stock that maintains a relatively stable price, that's going to be considered typically a low volatility stock. So, based on your account size, you have to ask yourself questions like, would you touch Zoom or even like Tesla with a $500 account? Now we know those can be pretty expensive. Keep in mind, the higher the price of the stock, the higher the price of the option. So you wouldn't want to touch a stock like that with maybe $500. So let's say you're only comfortable with trading with 30% of your overall account. I'm not talking about what you have allocated per trade, but I'm talking about what you decided that you are going to use to trade overall on your account. Let's just say you were trading with $500, you decided on 30%. That's going to put you at $150 that you are allocating to trade with. And you may want to invest the rest in stocks. Now, that 30% would be your risk tolerance for your overall account. So, what you want to do with that is make sure that you're trading something that's within your budget. You don't want to trade something like Zoom or even Tesla because that can wipe out your entire account. Then you would want to figure out what your budget is going to be and allocate that per trade. So with maybe $500, maybe you want to look at the S&P 500, something that has a decent amount of volatility, maybe AMD or Nikola or something like that, but you don't want to go for something that's extremely volatile because again, it can wipe out your entire account. All right. So now you also want to ask yourself, how can you maximize your gains by understanding the average true range and delta to theta ratio? So I'm just going to explain the average true range. So first and foremost, you want to make sure that you plot your levels of support and resistance on your chart. You can do this by actually using the support and resistance, or you can actually use the strat for all of the strat pack out there. Okay. Now this is going to help you figure out the direction and whether or not to do calls or puts. And next you want to figure out the predicted dollar move or the average true range and the amount of time that it's going to take the stock to make that move that you're basically calculating that it's going to make. All right. So a lot of people ask, how do you pick a strike price? How do you pick the expiration date? Well, this indicator, the average true range, is one that can help you. And I'm going to show you an example, but you guys got to just bear with me on this. Okay. Now, you are going to base this on the chart you're watching to gauge the overall trend and rely on what your plan is to swing trade. So if you're going to be trading over a daily time frame, or if you're using the weekly or the monthly chart, that's how you're going to basically view this. You're going to look at the chart that is basically going to correspond with your plan on holding. You look at the open and close range of the previous candles to get an idea of the dollar move the stock is capable of making. Or again, you can use the average true range calculator. Okay. Now, just to let you know with the average true range calculator, I know you guys see it on the screen, but it's a volatility indicator that shows how much a stock can move. That's why it's so dope, you guys, because it's literally going to tell you, based upon the time frame that you're looking at, how much dollar-wise that particular stock can move. So based upon that given time frame. But I want you to remember that it gauges the movement in price, but it does not gauge the momentum or the direction of the stock. Just want to make that clear. Now, once you figure out the direction, the amount, and how many days it takes to make that calculated move, what you're going to do next is multiply that by 3 or 5 if you have a high risk tolerance. So someone like maybe myself, or if you're trading with a high or a pretty significant amount, then you can have a higher risk tolerance. But if you're trading, and if you have a smaller account size, then you may not want to go as heavy when it comes to your risk. You may want to basically multiply by 7 or 10 if you have a lower risk tolerance. So I'm going to go through that with you and give you guys an example as well. But this is going to help you select a good expiration date. And keep in mind, I tell everybody this all the time. I love leaps. I love time on my expiration dates. The reason why is because you have to remember, more time gives you more time to recover if there is a reversal. That's first and foremost. You have lower theta the further that you go out. So you have lower theta that's actually eating at your contract, and theta is affecting your contract in real time. You can never pinpoint the exact time that it basically did that particular move when it comes to theta. But if you select a longer expiration, I guarantee you your theta decay is going to be so much longer. So please keep that in mind. All right. So here we go. I have this for you guys. This is going to be posted in Wealth Squad University. So you guys are going to have this so you know what I meant when I said if you have a high risk tolerance, you're going to multiply the days by 3 or 5. And then you're going to average up if that specific date isn't listed as an option. So sometimes it doesn't have maybe an option for every single day. It might just be weekly. So if it falls outside of that time frame, then you will just basically average up, not down. And then you're going to use 7 to 10 as your base, what you're multiplying by if you have a lower risk tolerance. Okay. So now let's just go over to TradingView, and I'm going to give you guys an example of what I mean. All right, so here we are. Let's look at Lyft, right? So I have this pulled up. I have my levels plotted already for support or resistance. I kind of did this earlier just for the sake of time for you guys. So as you can see here, I have my average true range indicator right here, which is pretty cool because let's just say I were to go to April 29th. If I look over here, and I can't move the mouse, you guys, so just follow me. So again, over here is where the average true range is. So I'm going back to April 29th. So just take a look at the average true range for April 29th. That's $3.18, right? And it's a calculation over the past 14 days. So let's go to a current time frame, right? So here we are. It's $2.97. So if I just scroll along here, it's basically showing me this stock can make about a $3 move per day. I'm pretty confident in saying, well, I like to average down, but it can really do a $3 move per day, right? So I have my lines of support and resistance drawn here. And let's just say I'm thinking that Lyft is going to make a move to the upside, right? That's what I'm factoring in. It's going to make a move to the upside. Now, I want you guys to remember this. It's important also. One very important thing, and that's why I have it here on the chart, because one thing that I notice in the community is that a lot of people have the right trade idea, but you're entering into your contract way too soon. And this is going to help you to understand that. So let's just say you were going to take this trade and you were going to do a put, right? Some people might enter right here. And I do see this problem a lot in the community. If you enter right here, guess what, you guys? You are holding for this candle, you're holding for this candle, and you have to consider that theta is eating away at your contract. And sometimes you may not be able to recoup that money. You know what I mean? So you're holding, theta is burning away at your contract, and God forbid that you're in a weekly. It took 1 tap, 2 taps, 3 taps before it actually kind of declined on you. So you want to make sure, I tell people maybe 2 to 3 touches. The more touches, the better. And personally, I like aiming for 3 touches because you always want to confirm whether or not you have a top or a bottom. If you're buying into a contract too early, especially a contract that's out of the money, but you don't wait on confirmation and you're holding over long periods of time, again, you might not be able to recoup that money, even if you are correct about the direction that it's going in. You have to remember the Greeks because those retracements will kill a potential winning trade idea. All right. So again, let's say I'm looking at Lyft and I'm thinking that it's going to do a $3 move to the upside. And for this particular example, let's say I have a high risk tolerance. Based on the average true range over here being almost $3 a day, it would take about, it's going to take about 3 days to make that move, right? If I'm multiplying by 3 or 5. Now, if I'm multiplying by 5, obviously it's going to take 5 days. So both of them are going to put me at basically a weekly. I can do a 1 week expiration. Hopefully this is making sense to you guys. And if not, just go back and watch the video because we have quite a bit to cover, okay? But drop a 5 in the chat if you guys are kind of understanding what I'm saying. What are we looking like, Ray?
It's looking good.
Okay, hey, I love it. All right, so that, like I said, that math is still gonna put me at 5 days, but this will not always be the case. So I just wanna give you guys an example of 2 different expiration dates, which is going to be, let me go back here. Let me go back to my slide, you guys. All right, so that's going to put you at, what is that? Right in my face, May 28th, and it's going to put me at, I believe, June 4th. So let's just walk through these examples of these contracts really quickly, you guys. All right. So again, let's just say I'm playing around with $500. I'm trading Lyft. Let's see what I can do to maximize that $500. And always, you guys, remember, as a general rule of thumb, when you're trading options, having higher delta than theta will give you the most returns, and it will maximize the amount of control you have over your contract, and it's going to give you a higher risk to reward. Okay. All right. So again, I have this breakdown here, you guys, so that you have it, as you need it. Now, when you're swing trading, and this is going to matter more for swing trading versus day trading. And the reason why is because when you're day trading, obviously you're not going to be in a contract for too long, maybe, 30 minutes, an hour, 2 hours, but you're getting out of that contract within that same day, right? But when you're swing trading, you're holding for overnight. You're holding for maybe a few days, a week, a month, who knows? It's up to you. But when you're swing trading, you have to make sure that your delta can actually override your theta. That's one of the reasons why I put on all of these slides that you're going to see, just so that you can have it. I put the ratio. So right here, if you basically divide the theta into the delta, it can go in there 2 times. So I put the 1-to-2 ratio. So hopefully that makes sense to you guys. But I'm going to go through it and I'm just going to help you to see exactly what it is that I see. So with this particular Lyft contract, with the $55 call, because from the previous price of the stock for Lyft, I thought that it could do a $3 move. So $55 might be safe. Multiplying it by 3 or 5, it's putting me at May 28th. I'm also going to do June 4th for you guys. So the $55 call for 528, it's a $46 premium. All right. So keep that in mind. It's a $46 premium. So with that $46 premium, I'm playing with $500. I could probably buy 10 of these contracts, right? And if my math is off, I'm sorry, you guys, but I'm just doing it off the top of my head right now. So we're looking at the $54 call for May 28th. It has a $70 premium. And I think if my math is correct, I wrote it on here. So I can buy 7 of these particular contracts, and it has a 1-to-3 ratio. Also, if I look at the $53 call, it's the $106 premium. I can buy 4 of these, and it has a 1-to-3 ratio as well. Now, let's go and dissect that a little bit more. This right here for me would be the winning contract, and I'm going to tell you the reason why. The reason why is because I can buy 7. I'm closer to the money. The Greeks are good, and the delta to theta ratio are still good as well. Now this, to be honest with you, 11 goes into 32 probably almost 3 times. It's not quite 3, but it's close enough. And this one goes into it probably 3.5, but it's close enough. So if I'm getting the same type of ratio as I'm holding, why would I not go with something that's closer to the money? It still gives me a pretty good amount of contracts that I can buy versus buying 4 over here. I can buy 7 of these. So it just kind of makes sense for me to choose this particular contract. It's closer to the money. The Greeks are good. I don't have to spend so much to get, quite a few contracts. So that just makes sense. Now, another thing that I wanted to show you all is what happens when you go too far out of the money. So I know some of you have seen those contracts that are like 1 cent. You go 20 strikes above the in the money, right? 20 strikes above the current share price, and you see the ones that's like 1 cent. It's a trap. It is a trap. It is a trap. You can even disable those because you guys, there's a high chance that those contracts are just going to expire worthless. And you have a lot of new people that buy so many of them, and they're losing money because they get stuck in them. They have nobody to sell them to because nobody is going to buy those contracts, right? So for this one right here, this is a lift contract, $60 call, 528. The premium on this contract is $5, you guys. Now think about this. The theta on this contract is $2. If you were to hold this contract for an entire week, obviously you can't lose more than you put in it. But if you hold this contract an entire week, it's a waste of money. It's going to burn. Your theta is just going to burn this thing up, and then it's probably not even going to reach that $60 strike price. So please, you guys, be very conscious of this when you're entering into these contracts. And then right here, it's showing you have almost a 3% chance of being profitable with this contract. Something that I told everybody before, your delta basically gives you an idea of how your contract can actually expire, if your contract is going to expire worth something or not. Your percentage profit is basically kind of gauged off of your delta as well. That's a quick little tip. All right, let's keep it going. Now, here is an in the money example. This has a $213 premium. We're playing with $500. I can buy 2 of these, right? Now, always remember, buying in the money does not mean that you are completely removed from risk. It does not eliminate your risk, but what it does is it lowers your risk, because the reason why it doesn't eliminate it, what if there is some catastrophic news that came out and it caused the stock to actually just drop, right? Let's say it fell all the way to 40 and you're in a $51 contract. Hopefully that gives you an example or illuminates how you're not removed completely from risk. It just lessens your risk, okay? So back to this, a 1-to-5 ratio, right? It's safer because you're in the money, and I like to play at least around the money. I don't want to go too far out of the money. I want to lower my risk when I'm trading. Even though I've been trading for a while, I'm not trying to go too far out. I don't want to play with my money like that. So this $51 call has a 1-to-5 ratio, but you can only buy 2 of these. And if you're a new trader, I definitely recommend staying close to the money. You know what I mean? Because you have a lower risk with your money, All right, so let's keep it going. So now we're going to look at June 4th, because again, I told you guys I wanted to give you another example. So with this $55 call, $93 premium, 1-to-4 ratio, I can buy 5 of these. I can buy 5 of these contracts. All right. So with the $54 call, it's $127 premium. I can buy 3 of these, 1-to-5 ratio. The 160 premium for the $53 call, I can still buy 3 of these, but this has a 1-to-6 ratio. I'm exposing myself to less risk. I have a higher profit percentage. I can buy 3 of these, or I can buy 3 of these. Why would I not choose this one? I'm closer to in the money. I can still buy 3. The Greeks are nice. I'm leveraging a higher delta to theta ratio. So this just makes more sense for me to buy this one as opposed to buying this one. Now, you can still purchase this one, don't get me wrong. But what I'm saying is you can still get just as much bang for your buck by buying this one right here. Okay? All right, cool. Let's keep it going. So here is an in the money example. Just want to let you guys again see how many that you can buy with this right here. So with this right here, again, you have a 1-to-8 ratio. It's not removing you entirely from risk, but I mean, it's safer. You may not be able to buy too many of these, but it's still safer for you to enter into this contract, okay? So this is a way to play it, especially if you're new. Even if you've been trading for a while, these are things that you have to consider, and this can actually help you to pick your contract. Now, there's so many other things that go into it. Obviously, you want to look at the volume and open interest, but let me show you one other thing that I saw. Okay, So here we have this particular contract. Remember, this is the winner. Look right here. The open interest, the amount of people that are currently holding this, 3,090. The volume, which is going to be the amount of people that are actively trading it within the trading day, is 166. You look over here, you have 350, 134. So most traders have this idea. So that's another cool thing that you all should look at, because that's just confirming what you're wanting to do. That's confirming your trade in a sense. It's not 100% foolproof, but it definitely helps you to see what other traders are saying. All right. All right. So that is all, squad. Let me see how long it took me to get through that. Oh, we're good. We have time to answer some questions. And you guys, it does not have to be specific to this presentation. It can be whatever you guys want to talk about, but we're going to answer a few questions for you. And I really hope that helped you guys. I promise I do. I truly hope that answers some questions for you all. Ray?
Yeah, what's up? You want me to go ahead?
Yeah.
All right. So if y'all have questions, go ahead and raise your hand. And then we'll call on you. All right, Connor, Marshall, go ahead and ask your question.
Yeah, so I had a question regarding the strat in using the hammer. As far as using that as an indicator, because I see hammers quite a bit, but they're red hammers. So does that not really apply as far as it reversing to the upside? Does that hammer need to be a green candle?
No, it doesn't have to be a green candle.
Okay, gotcha. So anytime hammer comes across, it's typically turning to the upside.
See, all right, it can, but here's the thing. All right, and this is what makes the strat so simple, so you don't trade with emotion. If it doesn't break above it, then you know what I'm saying, you're not in the trade. So you're always waiting for it to break above it. So if you see a hammer, mark the top of it. If it breaks above it, cool, you in calls. If it doesn't, then hey, next trade.
Okay, gotcha. And can you roll that? Can you roll that the top of that over multiple days? So say like it doesn't break above it the following day, but 2 days out from that hammer it does, or does it being not the next candle cancel it out?
For the most part, if it's not the next candle, it cancels it out. But sometimes there is times where it retests that entry point and it breaks through it. So
okay,
it's possible, yes. Because that's what Rob said. Sometimes the re-entry is better, but oftentimes it may show itself on like a lower time frame or something like that. So like let's say the hammer was on the daily, right? And it gets back to that point on the hour or 4 hour, it might be a one candle that gives you an opportunity. You see what I'm saying? So it's not
okay,
that specific candle, but it might be in that specific area. And that's why you also mark, the week high and lows to see where it is in reference to that. And the month, right? So like the month open, if you can find that candle and mark it, because if it breaks above it, like for instance with crowd was red on the month, it's still a 2 down, right? But it was a red candle and it just turned into a green hammer. The other day I think it broke over 209.50 or something like that made it go green for the month. So now it's green on every time frame right now. So that's another thing you want to pay attention to.
Okay, gotcha. Thank you.
No problem. All right, DeAndre Painter, go ahead.
Yes, I got a question about like basically, so I'm basically like completely new to this. And I was just wondering, like, you know what I'm saying, is this a good referral, you know what I'm saying, to use, or do y'all have anything that I can refer to as far as, you know what I'm saying, like basics?
The basics and stuff, you could look at like our old classes. Like the very first one I think that me and Kay did was on like support and resistance. But you can also look at market facts and resources. There's a lot of information in there for beginner stuff. And there's like even
cool.
a playlist that I put together. And I think we even separated some of the videos out the playlist that has like going over like the beginner stuff for options, like a whole beginner option video on the basics of it on YouTube.
Okay then. So like where can I find that? He said we're on YouTube.
It's in the Discord. It's called Market Facts and Resources. And you can just look in there.
Okay, good. Thank you.
No problem. Oh, let's see. Kim Joyce, you can go ahead and ask your question.
Hey, peace, y'all. So 2 quick questions. One, a refresher. When you're talking about the candlesticks now, the actual stick part, that's the new high and low for the day, but the actual block part, that's the old high and the low from the day before?
No, are you,
Dang.
so when you're looking at a candlestick, let me get
Uh-huh.
something pulled up because I want everybody to know how to read candlesticks. So hold on one second. One second, and then I'm gonna share the screen. So this should help right here. All right, great. And go back to that. All right. So when you're looking at candlesticks, and we use the wick because when you're looking at the wick on a longer time frame, the wick can actually show you how price action moved on shorter time frames, basically. So if you're trading off different time frames, the wick is actually important too. So when you're looking at bullish momentum, this is where your candle open. So it always opens below the close because you're thinking when it's bullish, the price is actually going up. So if you keep that in your mind that the price has to go up, then wherever it closed at the top is going to be wherever it went at the top, or the close of the candle is going to be your bullish candles, right? Because the momentum, or the candle rather, is actually going up. Your wick is going to be the high. So that basically means at some point throughout this, the trade of this particular candle, or the time of this particular candle, it reached this high, but it failed to close that high. It closed right here. Okay. And then the low is how far down it actually went, but it couldn't stay there. It didn't stay there. So that basically is important as well. When you're looking at a bearish candlestick, you have to think the price is falling down. So the open is going to be above the close. So this is where the price started, but it fell, and it fell down here. And this is how low it actually got, but actually it closed here. And this is how high it got, but it still closed here. So hopefully that makes sense. And then when you're looking at, let's say, for example, when you're looking at a candle like a doji candle, which is one of my favorites to trade off of, let's just say the candle looks black. So basically you see a line, you see this really thin line right here, and then you see a wick right below it. That basically means that the bears and bulls were fighting. Nobody actually won that battle. So the price actually opened and closed at the same amount, or around the same amount. Does that make sense?
Oh, let me see. Where's X on mute?
Hey, there you go. Can you hear me?
Yes.
Oh, no, definitely. I had like a major brain fart, but I think that you explained it so good, I won't have another brain fart about that again. Now, the second question is, can you go back over the expiration dates, picking the right expiration dates? Because I feel like I'm always right. Picking the, sorry, I'm on a bike. I'm always right. I feel like picking the where it's going to go, but I'm always like too soon on my expiration date.
Yeah, so that's basically what I was talking about, where you're entering too soon. You want to make sure that it has multiple taps off of your areas, your support and resistance. So for example, when I said it was 1, 2, 3 taps here, if you would have entered in right here, that's what I mean when I say so many people have the right trade idea, meaning that you're right when you're, or in most cases, some people are right when they think, oh, I should do puts on this. But the problem is they're losing money because they're entering too soon, and they have to hold for this state of burn. They have to hold for this state of burn. They have to hold. And then it finally does the move. And by that time, your contract, depending on how close your expiration is, you could basically be losing money. So one way that I'm saying that you can actually figure this out is you want to know your average true range. Your average true range is going to be the dollar move that the stock can actually do. There is an indicator that actually says average true range. This stock right here can move about almost $3. We're looking at LIV. So it can move about $3. I have my lines of support and resistance drawn. So the stock is currently, let's just say it's at $52, and I think that the resistance is like 54, 56. I'm just going to say $55. That's a $3 move. How long can it take this stock to do that? Well, the average true range says that it takes it a day. You know, it moves about $3 in a day. So I'm going to multiply that one day. If I have a high risk tolerance, I'm going to multiply that one day by 3 or 5. So that's basically how you can gauge your expiration date. So if I'm multiplying by 3, it's going to say I need to choose an expiration date that's 3 days out. But in most cases, you're not going to have the ability to do 3 days away. You might have 5 days. So I might be looking at something for this Friday, or if I want to be even safer, I'm going to look at the following Friday. Now, this is if I have a higher risk tolerance. If I have a lower risk tolerance and I'm not trading with a whole lot of money and I want to make sure that I'm not losing so much, I might want to multiply that one day by 7 or 10. And again, we can't do 7 or 10. So maybe I might want to choose something a little further out that, you know, coincides with what the expirations are. If it's providing me with weeklies, I always want to average up, and that's going to help me to pick my expiration. So you need to know how the stock can move dollar wise. That's number one. You want to know how long it takes to make that move. And then you want to actually dissect the contract to make sure that you're choosing something with good open interest, with good volume, and with good Greeks. Does that make sense?
Hey, I'm there. I'm in the money. I'm making money now. Let's put it together. I'm good. Thank
I
you.
love it. I love it. I love it.
Yep.
And you guys, in this game, it's always good to just average up. You know what I mean? Like, you always want to make sure that you're giving yourself more time. It's nothing wrong. If you see something get called out in the community and you know that you're trading with a, you know, a low risk tolerance, if we call out something and we say this Friday, if you have the capital, you guys, go out further. You know what I mean? Because what happens is it can reverse. You know what I mean? It only takes one bad news. It only takes Elon to get on his phone and start being Twitter fingers. It takes one bad catalyst to make the stock drop. But if you have more time, you have, again, less theta eating at your contract, and you have more time to recover, because one day they could post something bad and it could hurt your contract if you're doing calls. And then who knows, a few days later, they might say something that makes it run up. But if you don't have a lot of time to play with, then that could really mess you up. We good?
All right. Dang, they're probably not gonna know who they are. Zoom user, you can go ahead and ask your question.
Okay, thank you. So I'm still pretty new. Joined last week. I've been trying to get into the resources and watch the videos. So I do appreciate that. It's kind of like a two-parter. Can you kind of explain in the money and on the money? Like, I just haven't been able to like kind of grasp like that, and I need kind of a better breakdown.
Yeah, so I can give you a really quick like overview of it, but I will say, just for the sake of time, we do have a breakdown of those basic fundamentals in Wealth Squad University.
Okay.
So when it comes to in the money, you're playing on intrinsic value. You're basically, the price has already exceeded those amounts. That basically is what in the money means. So anything like if it's a stock that's $10, you know, in order to get to 10, it had to hit 9, it had to hit 8, it had to hit 7. So 9, 8, and 7 would be in the money. If the stock is $10 and you see an option for a $10 contract, that's going to be at the money because it's at that current price. Out of the money is extrinsic value. There is no value within it. It has to move in order to reach that value. So extrinsic, or I'm sorry, out of the money is basically going to be if the stock is $10, 11, 12, 13, and keep going up. Any of those numbers would be considered out of the money because the stock has not reached those numbers yet.
Okay, perfect. Thank you. Last question. When you were talking about ratio, and I guess, how does that factor into everything? Or are you just dividing the, I think it was it the theta into the delta, or?
Yeah. You're dividing
Okay.
the theta into the delta.
Perfect. Thank you so much.
No problem. And you guys, your delta is basically going to be your money. That's what you're making when the stock moves $1. Now, there is so much more that goes into it. Obviously, the gamma, but I'm not going to bore you guys with that. We did a video on the Greeks. It's in the channel, but you always want to have high delta, low theta. And if you have the reverse, you want to make sure that that stock is able to move the amount of dollars that it needs to cover your theta.
All right.
All right.
Mike McLean, you can go ahead and ask your question.
My question was actually answered, so thank you so much.
Thank you.
Okay, great.
Love the picture.
No problem.
Thank you.
All right. Oh. All right. I'm try this. Kawaku Stone, you can go ahead and ask your question. I think I said that right. Yeah. Where? K Stone.
Are you there?
All right. Okay. Well, next then. Dinu, you can go ahead and ask your question.
Hey, can you hear me all right?
Yes.
Yep.
Okay. Two-part question. One was when you're buying a contract and you want to assure that the contract gets accepted, what's the best place? How do you set the limit price? Sometimes I've automatically set the limit price at the lowest at the bid price and it doesn't fill. So should I go closer to the ask, somewhere in the middle? You know, I'm just wondering where's a good place to pick to make sure that the contract gets filled. And the second question is, why is a doji candle your favorite? Is it because the next candle shows the action better?
Yep. So I'm going to answer your second question first because that's my favorite one. The doji candle, again, is basically a fight between the bears and the bulls. And typically, I'm going to say 8 times out of 10, really, I would say 9 times, but I just want to, 8 times out of 10, the next candle is going to show you who won the fight.
Right. That's what I thought. Okay.
And when it comes to why your order is basically still pending, or if it hasn't gotten filled, it could be the amount that you're trying to get it filled at. And there obviously has to be someone that's willing to sell it to you that cheap. So you can raise it above the ask, or you can take the mid within your platform or your brokerage rather, if you want it to get filled. If you're okay with spending the extra money, you can set it above the ask, but you always want to buy low and sell high. You always want to buy at wholesale and sell at retail. So if the stock could potentially reverse and pick up a cheaper order. So that it's just completely up to you, but that's one way to do it. You can set your limit above the ask price.
Okay, thanks.
No problem.
Hi, can I please ask my question? This is Keystone.
Oh yeah, go ahead.
All right. So I see that on your charts you have 2-3 on the candlestick. Is that an indicator?
Yeah, that's the candle type indicator on TradingView.
So it's like I use TradingView as well, and I've been trying to find what indicator it is. Can you please show me if that's possible?
This is it right here. Candle type, the strat. Can you see that?
Yeah.
Okay, so that's what you would type in. You would type in candle type, the strat. And if it helps you at all, you may want to just put highlight the star too, so that you can always have it there if you're ever trying to reload or create a new chart. You have your favorite ones highlighted.
All right. Thank you very much. And is there a video that shows you how to understand the 2, 1, 2?
Yes, Ray did some phenomenal videos that are located in Market Facts and Resources.
All right. And the title is The Strat?
The Strat. The Strat.
All right. So if I go into the resources in the Discord and I look for candle type videos, I want to know the title of the video.
You're just going to go into Market Facts and Resources, and it's listed the strat. You're not going to miss it, I assure you. It's posted several times a day. Also, for anyone that's new in the Discord, if you're using the Discord on your phone, swipe left in whatever channel that you're in, check the pins. A lot of times, a lot of you guys' questions are already answered, or you can always go to Market Facts and Resources. We put pretty much a lot of the things that we talk about that we know that are important. We put it in there, so you always have access to it.
All right, I guess should be good. I just posted it for you, K-Stone. And then Dinu, we already answered this question, right? Yeah, I think so. All right, so Connor Marshall, you can go ahead and ask your question.
Yeah, I just had two quick ones. For trading off the doji, is that something that you typically do more of intraday trading with?
I can do, you can do, I'm sorry, were you gonna answer that, Ray?
Nah, because he's asking because of you.
Oh, okay.
Yeah.
Well, yeah, you can do it on any time frame. Like, for example, this is a hammer candle right here, but this is kind of a doji. If you can, if you can follow like my mouse, if you see it basically opened at about 52.46 and it closed at about 52.31. It wasn't that big of a move. This is practically a doji candle. You can't really see who won the fight because it opened and closed like basically near the same range. But this right here, there we go. There's a doji. There's a doji. Okay, so right here, this would be a doji candle, and as you see, the next candle is green, and what happens? It kind of runs up. So normally, what follows the doji, they won the fight.
And you enter that play following the next candle passing the doji's wick.
Well, it just depends on if you're trading the strat or not. I'm kind of
say I'm using the strat.
yeah. But what I would typically do is obviously I wouldn't enter if it's too close to how can I say this? If it's not going to give me a good risk to reward. So I'm not going to enter right here, but maybe I'll enter once it breaks above here so that I can have a pretty good risk to reward, because there's a chance that it can always reverse on you and then the fall will be greater and you don't have too much room to run up from this point. I mean, you could if you're going to day trade and you're just going to take a few, maybe 50 cents or something like that. Well, actually, that's a pretty decent move. Oh, I'm looking at the daily chart. I'm so sorry. So yes, you could definitely enter once it breaks above. But I would be trying to probably get out if I was day trading somewhere around here. Maybe wait for another re-entry to go above.
Okay, cool. And then the other question was, when you're talking about multiplying by 3 or 5 on that day, are you talking about multiplying the average to your range by 3 or 5 for that day?
No, I'm okay. So what I mean by
I'm just not understanding what you're multiplying 3 or 5.
Okay, so I'm thinking that this could do a $3 move, right, in one day.
Yes.
The reason why is because the average true range is basically telling me that this stock, and keep your eyes over here as I move along, right? So
yeah,
that'll help you. So I'm moving along. This stock is basically showing every day it can do about a $3 move. I'm looking to trade this for the $3 move based upon my support and resistance, right? So if it can do $3 in one day, I want to play safe. I am trying to do risk management. So if it can move $3 in one day, I'm multiplying that one day because I have a high risk tolerance. I'm multiplying that one day by either 3 or 5.
I'm not following. What do you mean multiplying the day's average true range? You're multiplying by 3 or 5, or I'm not understanding what you're multiplying by 3 or 5, I guess is the thing.
So this is to help you to basically select the correct or select a good strike price, right?
Mm-hmm.
So on my levels of support and resistance, I'm wanting this stock to go from about $52 to maybe $55. Okay, so somewhere here, because this is going to be considered a zone for me. So I'm going to be looking at it to go from about 52 to about $55, right? That's the run up between here and here. So that's a $3 move. I have to ask myself, how long would it take for this stock to move $3? So I'm using my average true range indicator, and my average true range indicator says that every day this stock basically moves about $3
to $5. Yeah.
So it takes one day for it to do that. But because I don't want to have a very short expiration, because if I'm wrong about my trade idea, I'm screwed. I lose my money. That's about options. So what you do so that you can actually maximize your wins, your win rate. What you're doing is, if you have a high risk tolerance, you're figuring out the dollar move that the stock can do. You can use the average true range indicator. You're figuring out the amount that it can move. You're plotting your levels to see. So for example, from here to here, that's about $3, right?
Yes.
And that's my resistance point. That's where I'm expecting it to move. If I'm going to do calls, that's where I'm expecting it to go. So it's already right here. It's at 52.32. So let's just say $52. We
Mhm.
want to get into the zone of about 55. That's where this line is. That's my resistance. So if it's going to do that particular move, that's a $3 move. It only
Yes.
it only takes this stock one day to do $3. I'm multiplying that one day by 3 or 5 with a high risk tolerance. And if I have a low risk tolerance, I'm going to multiply that by 7 to 10 days and average up. So that can help you to choose your strike price.
Okay. So that's just giving the multipliers is giving you how many your date.
Exactly. You're multiplying it is giving you your days. What expiration date should you be looking at?
Okay.
You got it?
I think I'm trying to grasp it. I'm just when you're saying multiplying the day, like are you talking about the strike price you're multiplying by 3 to 5? Are you multiplying the day's average true range by 3 to 5, or your
So
strike
my strike price would be 55. We're at 50.
because that's its resistance.
Exactly. So I'm looking for it to get around 55 because I'm in this zone. Okay. That's
Yes.
not zone, but I'm in this zone. So I'm looking for it to hit about 55. It's at 52 right now. It's a $3 move. I need to be able to pick a strike price. I'm sorry, an expiration date. I need to be able to pick an expiration date that's going to give me time so that I am maximizing my profit potential, and I'm also not I'm buying time so that it doesn't reverse on me and I'm completely out of my money.
Okay.
That is what this is for. This is going to help you to pick an expiration date.
Okay.
Mhm. Now
Thank you.
You can easily choose one day, but if it reverses, you're screwed because in the options game, you're going to lose everything you put in.
Yeah. No, that's just kind of what I was curious about, because I mean, the average true range is showing you that it can do that in one day. So it's like, why wouldn't you just pick it the same day, or a weekly contract?
Yeah.
But obviously you can get clapped pretty quick. So that's why I was just trying to figure out, like, what does that multiplier gives you an actual date or something like that?
It's going to give you a date, because if I'm going to multiply it, if I'm going to multiply 1 by 3, that's going to be 3 days. There's not going to be a 3-day, it's not going to be an expiration in the middle of the week for this. So it's going to be that Friday. It's going to be 5 days. So that would be the expiration I would choose if I have a high risk tolerance. You know what I mean? And so that's a play on safety, because guess what? If it can move $3 in one day, it has
it can go down.
It has 5 days to do that. So if it goes down, what if it goes back up? You have more time on your side.
Okay. Gotcha. Thank you.
No problem.
All right, Danae, you can go ahead and ask your question.
Hey.
Hey.
All right. So I have 2 questions. Hopefully it goes by fast. But so for my first question is the MA 20, 50, and 200. How can you tell when it's bullish? And how can you tell that it's bearish? Because I always kind of get mixed up with that. And then my second question is for the support and the resistance. Pretty much, like, how are you determining when you should go up for calls and when you should go down for puts? Pretty much. Like, what week do you go by, like a certain week? Like, okay, so for this week, the lowest was 50, but the highest was 55. So are you saying to yourself for the week it needs to break below 51 for puts and above 55 for calls? Or are you going by the monthly, the weekly, and the daily to determine, like, what you want to do, pretty much?
So I'm so sorry. I want to answer both of them. Ray, you're going to have to help me out with this one. Your first question was, how do we know when it's bearish or bullish, right?
Yeah, for the MAs.
Okay. So typically, you're going to be looking at your price action and which moving average is respecting in most cases. One key thing, and also I want to let you know, we have a video on this as well. So if you have a shorter moving average that's above a longer term moving average, that's typically a bullish move. If you have a longer term, a shorter term moving average that's below a longer term moving average, that's typically a bearish move. But you want to make sure that you're looking at which moving average the stock price typically respects, and that can help you as well. When you see price action fall below that valuable moving average, then that can also be a bearish indicator. And if you see that it's cutting above, then that can be a bullish indicator. And I know that's a lot. It's so much more that goes into it. But we do have a video on it that's going to break it down so that you can understand it. It's kind of like a cheat sheet video.
Okay.
It's when to buy calls, when to buy puts. And Ray, I need your help because I kind of drew a blank because I was trying to like understand the first question and then the second question.
I mean, the second question, when it comes to moving averages and stuff like that, right? Because the second question was, when do you determine if it's calls or puts? Because
Yeah,
that's
so
like
like
support and resistance, which I don't.
support and resistance, yeah.
Yeah, and I don't use that. So,
You did though, Ray. Point.
Because I
I'll
know
put
you
that
gave us
completely
homework
online.
on VixK, and you know I did the homework and all, but
Okay, so your question was, and I'm so sorry, I was trying to gather your first question. You know, I'm
no,
listening,
it's okay.
so I wasn't tuning you out, but I'm like, what is she saying? So obviously, when it comes to your support and resistance, you want to make sure, like I stated before, you want to make sure that you have your multiple taps on your line, and you want to make sure that you're seeing what the actual price action is doing. You want to look at actual price action. And
Mhm.
sometimes it's good to just have a clear chart so that you can see the overall trend. Like if I were to zoom out of this particular stock, I can see long term, this stock is bullish, right? It traded sideways here, it fell. But if I'm looking at the overall picture, this stock has been pretty bullish, right?
Mhm.
So you want to look at the trend, but you want to make sure, and this will help you too to have the full time frame continuity, but you want to look at the price action and see what it's doing. You draw your lines of your support and resistance, and you're basically waiting. You want to make sure that you have maybe an entry. If you're thinking that it's bullish, you want to have an entry somewhere around here, because guess what? You get to capitalize on this entire move. But oftentimes what I'm seeing is that some people may enter like about right here, or maybe that's not the best example. I want to see where it could have potentially failed. Okay, so right over here. So sometimes traders get into trades and they're entering on this candle right here, right? They're entering on this candle right here. You don't have that much of a risk to reward because it falls, and when it falls, it takes pretty much all of your profit, right? Unless you're smart enough to get out. So you want to make sure that you're entering at the right time, because that's another thing. But what you're looking for again is you're looking for your multiple taps. You're looking to see what is going on with your moving averages. If I had the RSI on here, you'd probably be looking at the RSI, the MACD. But again, we have a video that's gonna like go over all of that stuff. And again, it's a cheat sheet. It really is. It's when to buy calls and puts, and it'll break everything down for you.
Thank you so much.
No problem.
Hassan, you can go ahead and ask your question.
Hey Ray, hey Kay, thank you guys. I'll try and be real quick because I know it's 6 o'clock. Ray, when I was rewatching your watch list video, right?
Yep.
And I know you start on the monthly, you plot your points, your entries on the monthly, then the weekly, the daily, and then the 60, right?
Mhm.
When you do that, right? And then so for example, say like it passes say it passes a wick for you to buy calls going up. When you're looking at like contracts to buy, right? Do you like how do you know basically how long you're planning on holding that contract for? Like, if that makes sense, you know what I mean? Like, do you go based off of if it passes it on the monthly, or say it passes on this on if you get an earlier entry at like the weekly? Like, how do you know how long you're holding it for?
All right, I get what you're saying. 1 second. Let me pull up this chart. CRWD. Yeah. Let me share screen. Which one do Which one is it? All right, here you go. Screen 3. All right, you see my screen, right? Let's see. Where did that go? All right, it's over here. So participants. All right, so you can see my screen, right, Hassan? Because I don't know what you.
Yeah, I can see it.
All right. So when you're asking me how long would I hold it, all right. So, and because you said you watched the video, this
Yeah.
is crowd. So obviously, you know, in that video that this candle hadn't happened yet, all right. So when I'm looking at it, let me delete this because I already did that video. But yeah, so whenever you're looking at it, whenever I first plotted it or was trying to look at it and figure out what I wanted to do, I realized that I had two price targets to hit, right? So, and this is on a weekly chart. So when I'm looking at how long am I holding it, it's going to be one based off of what ends up being my profit, right? Because if I hit a certain amount with profit, then I might go ahead and hop out and then re-roll the contracts. Like this one right here that I got ready to sell, that's not my initial contracts for crowd. So when I'm looking at it, I'm looking at it more so at a mindset of how long is this trade going to be good for me? I might not hold the same contract all the way through. I'll take profit and then re-hop back in it. But like, let's just say, for instance, that I'm looking to hold the same contract all the way through. I would make sure, because it's two price targets, I'm probably either going to get a 3-week contract or a 4-week contract. So it's either going to be 3 weeks out or a month out. All right. An initial contract that I did have was 2 weeks out because I already knew I was going to roll profit. I was going to hop out and then buy another contract and buy further out expiration date. So with this trade idea that I'm looking at, I'm looking to at least be in it for at least 2 weeks, but probably a 3 or 4 week expiration. So let me bring back up that participant thing. All right. So does that make sense to you? Does that answer your question?
Yeah, bro, definitely. I really appreciate it, man. I was, like I said, I was watching and I was like, well, damn, how long is he planning on holding these contracts? But that makes a lot of sense. Thanks, man.
Yeah, I don't want to hold profit if I see enough profit on it. Like how you see how big this candle was, you'd be crazy to keep holding it, and then the next week you got it could
Exactly.
go
And
red.
I didn't even think about that. I forgot. Like, obviously, if you're making profit, you might want to take profit or just, close out together. I didn't even think about that part. So, yeah,
Right.
appreciate you, man.
Yeah, no problem.
All right.
All right. And then I think it was Jaquan Ambrose. All right, so you asked me to go over broad information real quick, and then that'll be the end of class. All right, so when I'm drawing broad informations, so if I delete this one, move it, move. Basically, to simplify, you're looking at where price has the last like price target or pivot that price hit and then reverse. So if I was drawing a broad information on the weekly chart, I'm going to draw from here because it went up to this high and then it reversed and went down. All right. And so basically that's telling me that's the high. Right. So I'm waiting for price to get back up there if it ever gets back up there, because the original broad information would have been from this high. Oops, I got the wrong drawing tool. Remove. Boom. It would have been from this high to this previous high. All right. Because this is higher than here. So you draw back from the current high back to the previous high. All right. So this used to be the top, and it still technically is the top of the broad information, but it ends up creating a new one. So if I plot the low too, price came down, it took out this pivot. This was the last pivot it took out. All right. So before it reversed back to the upside. So I would draw from here to here. And as you can see, it never created a lower low than this one. So technically, if you wanted to always readjust your broad information, you could readjust the bottom of it, because basically all you're looking at is where did price go down to and stop and reverse. All right. Once you get the clear reversal back to the upside, you know that's the bottom of the broad information. And so when I was making this video before, I was like, there's a new low to the broad information. It stops right here because price hit right here, formed a hammer, I said it's probably going to reverse. If it does reverse, that's the bottom of the broadening formation. And it did end up reversing back to the upside. And so for right now, this is where price stopped before it went down before. So that's why I have that as the top of the broadening formation. I could either draw it like this, or I could draw it back to right here. But I just draw it back to the previous high. Sometimes the one that's right next to it, if it doesn't make it too high, because if I drew it from here back to this one, it'd be like a sharp angle that's too high. So sometimes when you're drawing it, you're really just eyeballing it. Sometimes if it doesn't give you a clear point to draw back to, like it did with this one back to here, or this one back to here. What's the other thing? But it's basically all broad information is getting your eyes used to seeing. Let me remove all this. That basically price moves almost like a heartbeat monitor, right? It doesn't go straight up. It doesn't go straight down. It does like this little wiggling thing, which on a higher time frame, if I go to the month, you can even see it right here. Boom, boom. So if I draw it on the monthly, it'd be back here to here. Or if I drew it, the new one, boom. So it's just getting your eyes used to seeing that price is wiggling around. And like I said, moving like a heartbeat monitor in a way. And for me, it kind of shows you that sometimes support and resistance can be horizontal sometimes, because price, all it's trying to do is take out one side of the range, come back and take out, go to the downside and take out the downside of range. So basically, like a lot of times when you're looking at broad information, you're looking for threes or compound threes. And basically a compound three is two candles put together. All right. Because we see, or what Rob teaches, that we know price likes to get outside of a range. And so if you look at this candle broke the high of it. And then this candle right here broke the low of it, which creates a broad information because price has went up higher than this range, and it has also went lower than this range. It's not going to always come down and try and take out down here or down there. Sometimes it's just trying to wiggle out and take out one candle. All right. So let's see what's in here. Okay, cool. You got it. Okay, you got anything? Let me stop share. I kind of got like sidetracked.
Oh, I got muted. Wow. Do I have anything to say? I love y'all.
Oh yeah. Go ahead. I forgot. I almost forget the thing that I was about to do.
Okay. So, no, I don't really have much to say. You guys, thank you so much for coming to class. It means so much to us that you guys show up because we legitimately put so much work into these classes. Like, let me tell y'all, I just have to say this. Please don't leave yet, you guys. Just listen to this. Keep this in mind. We trade with you all throughout the day, Monday through Friday. We're answering questions and DMs all day, every day, and we love helping you all. After hours, we're putting, more work in by answering questions for the people who are studying and going over watch lists. On the weekends and late at night, we're putting together these presentations. And then on Sunday, we are presenting them to you all. So it means so much to us that you do come to these classes because it's a lot of work. We love you all. Follow us, please, on our social media pages. Show us love.
Ray Jessamine, you know what I'm saying? Yeah.
I Curly K. Somebody asked me, what my name was on there. It's the same everywhere. But yeah, we really appreciate you guys. You guys are awesome.